All right, everybody. Welcome back to the Rob Review. Your friend in success, Robert Morris, coming to you today with a brand new microphone. Really trying out to, increase my, not just my reach with the podcast, but increase my availability to do more podcasts for you. So I invested in some podcasting equipment that I feel like will really bring up the quality of the show. So, those of you that are returning, you know I'm big on it doesn't matter where you start. You just got to start building wealth somehow. Those of you that are new, today's topic may scare you a little bit. The idea here is if you're a millennial and younger, has time run out for you to build wealth? Is it over? I mean, is inflation killing your money to the point where you cannot save any money to start? Is debt eating millennials alive? Are houses so expensive that nobody can buy the biggest asset that most people have, which is their home, which is kind of a falsehood, but is it really over with? That's what we want to talk about today. And the idea here is, look, people, if wealth building for millennials was not a thing, if you couldn't do it, then I would not be where I am. I wouldn't be having the assets that I have. I wouldn't be here doing the show because this show is not something I do just randomly. Everything that goes into this show is because of an asset that I built with my family to be able to have a studio and the equipment and all that stuff to do a show for you. So wealth building cannot be over because I am a result of the ability to build wealth first generation. However, where I got that idea from was a podcast from a real estate guy who makes a lot of sense when he talks about especially real estate building wealth for first generation people that are millennials and younger is not an easy task now. And the stock market is way different. And what I want to do by the end of this podcast is have you really understand ways you can build wealth in the stock market and take from this podcast and start building wealth right now. And I have I'm conflicted because I was always taught it doesn't matter what environment you start in. You have to just get started. You can't help the economic times you were born into. Imagine people that were born into the Great Depression. I'm sure it wasn't a fun time for them to start building wealth. Or imagine people, back in 2008 that lost everything and had to restart. Or imagine people that had just started in 2008. You see what I'm saying? The economic winds are always changing, and they can't always be in your favor unless you know strategies to be able to profit no matter the economics of the current situation we live in. The stock market is not linked at the hip with the economy. It just isn't. It's not tit for tat. You have bull markets, you have bear markets, but the majority of the time, I would say 2/3 to 3/4 of the time, the market rises, and the rest of the time it falls. The problem is when it falls, just like gravity takes the market down, just like gravity takes an apple, you throw off a roof down to the ground faster than it took you to climb up to that roof to throw that apple off, the market drops like a brick much faster than it rises. And when it happens, people panic and they think that the bull market is over and the bear market is never going to end, and people are not prepared. And so when you have situations like you have right now where the market has been declining rapidly since the beginning of September, you either have people like me that are there prepared and profiting from people that are not prepared, doing the wrong thing, and I am taking money from you. And that's what the market is about. Somebody has to lose for me to win, and I'm okay with that because I prepare like a soldier to go into battle. I prepare like a hunter to go in and cut my chunk out of the market and take it home for my family to eat. And for you that are listening to this podcast, you're my investor family that I want to benefit from that knowledge of being able to, hey, Robbie says, and so I'm going to go in and I'm going to do the same thing. You're going to be able to be the professional hunter and take from those that are not prepared. So the first thing you must know to build wealth in this economy is you have to be prepared. There is no ifs, ands, or buts about it when market downturns happen, because You don't have the ability to miss out at this juncture in your life on massive opportunities to buy at discounts. You have to, it doesn't matter how much money it is. It's just got to be something that you put in and are prepared to buy. Now, what to buy is a whole nother scenario, but you want to be prepared to buy. That is number one. And then you have to realize that, look, inflation's always going to be a thing. It might go down, it might go up, but it's always going to be a thing. Taxes, as a general consensus, are always going to be higher later on in our life than they were earlier in our life because taxes just don't seem to go down, they seem to rise. Your money is going to be worth less. Right now, your working years are the best years of earning power you have. So therefore, the next piece of the puzzle is, don't just try to save your way to a principle that you can start investing with. I want you to trade your way to wealth. That's the way that I see it, guys. I'm not one of those people that thinks that the best way and the only way is to invest for the long term. I believe that it is a three-pronged system when you approach the market. And the first piece is, and should always be, buying assets for the long term. Now, the long term is different than it used to be. It may not be 20 years. It may be more like 10 or 7. And I really think that there are better assets out there than some really high-quality stocks that people are touting because they're too high-priced. I think you can build cash flow and assets of a different breed or buy into small business assets, medium-sized business assets as a minority shareholder investor, and that is where huge growth is going to happen. And that is where the most growth, I believe, is going to happen with us millennials investing, because there is a stronger selling pressure building in the market. Where is it coming from? It's coming from the fact that our parents and our grandparents are getting older, and they have shoved money into mutual funds and 401ks and retirement plans to the tune of trillions of dollars. Maybe not, obviously not singularly, but as a whole. Now, what's going to happen when they all go to pull it out? They're not going to all pull it out at the same time, but over a 10-year period, you're going to have a lot of money being pulled out of the stock market, little bits at a time. And it's going to cause, and this is a whole other podcast, but it's going to cause a cascading effect on the market that will bring it down lots. I mean, you're talking of the possibility of a Dow at 30 or 40,000 going down to something like 15,000 or 20,000. If it gets to that point, you're talking about huge, huge declines, not tomorrow, not 5 years from now, but once it starts, it's going to be a cascade where you and I can't put enough money into the market to compensate for the huge sums being pulled out. But what does that do for you as an investor if you're not prepared? It's a fearful state of mind. It scares you into sweating right now. But I can prepare you. You can prepare. One, go read the book Boomernomics. That's where I learned this from. It's not just an out there theory. It's very factually based when you look at how society and economies and businesses have grown, succeeded, and failed based upon the baby boomer generation and their buying power. Secondly, investing with the knowledge that they are getting older is a way to figure out what to buy. Thirdly, you should be able to, if you trade your way to wealth, understand that whether the market is declining or rising, you can make money. The only place in the market where I can't really make a lot of money is when it goes sideways. When the market is declining, I can make money faster than I can when it goes up. When the market goes up, I just sit there and wait and wait and wait and wait. But when it goes down, I take huge, huge put options and I make huge, huge money. And you can do the same thing. And so what I'm saying is, Change the way you're thinking. Don't be worried about inflation's eating away my money. I did a newsletter on this last Saturday. Make your own damn inflation number. You can do it. And I'm not, one to get angry. I'm just angry at the idea that we've never been taught to be self-sufficient in our own thought process of how to manage our budget like if we were our own government. If you were your own CEO business of Me Inc., you would know your inflation numbers. You would know the products that you need to increase in price to have the same profit margins. So, write down things that you buy on a regular basis. 6 months, 12 months down the road, write how they have changed in price and see the difference. And that percentage is your inflation number. How do you build wealth when inflation is killing your ability to save because your earning power? You might have had $1,000 extra in your income 2 years ago, and now you've got next to $300 or $400. It hurts. I get it. That's why trading allows you to compound, and instead of that 12% eating away at your money, you're making 20 or 30 or 40% a month, and inflation, it doesn't matter as much anymore. See, that's the difference. I don't invest money that I worked my butt off for. I invest money after I work my butt off for it, and after I trade it and compound it, and then I invest a portion of it in long-term assets. And then the other portion of it goes right back into compounding, but it's always the biggest portion that goes to the investment asset long-term, because long-term has always proven, Warren Buffett, John Templeton, so many others, that if you invest long-term, you will benefit the most over time. But yet I incorporate trading strategies that have made other people incredibly wealthy to compound my money to give me buying power in investments that other people just can't match. And so I kick out other competition that wants to invest in the same things I want to invest in. So really what we're trying to say here is that yes, you can build wealth, but you have to be more strategic about your thinking. Opportunities out there do not abound in the way they used to. And I'm not saying, I know there's a mindset idea that, when you really look out there, there's so many opportunities, it's overwhelming. And that's true. But the best opportunities are not so abundant that you need to be worried about, I don't have enough money to put in all of them. You need to be worried about somebody beating you to the punch, especially in the market, and especially when it comes to the way that I talk about investing. So, get you some money together, and instead of putting it into a stock, get a half of it or a third of it, and learn to trade it in a compounding way. I would suggest that you trade something like an index that moves really well, and you can learn to study the movement of that index. The S&P 500, you can trade the spiders, which moves with the S&P 500, and you can benefit from the movement of that index 1, 2, 3 times a month trading it. 20%, 30% a month is your goal. My goal is always to grow my account balance by 20% a month. Therefore, if you trade 2 or 3 times a month, and your trades are 20 or 30% gains, every trade, a third goes to taxes, a third goes back into your account to grow it, and a third comes out and goes to a separate account where you are going to invest that money when opportunity rises. And you just keep compounding that and compounding that and compounding that. And before you know it, when opportunities hit like what's coming down the pipeline now, you're not saying, how can I sell my car, or how can I get an equity line on my home? Or if you're like me and you don't own some massive home because the equity being built up in it is not there because of the because of the cost of real estate now. You don't have to worry about getting lines of credit to invest. You can say, I'm cash rich, I've got the ability, and you can be the person that when somebody wants to develop a new development and they need to tap a $5 million loan, you can say, I got $500,000 cash. I'll let you tap the loan with my money, and you return me X amount in 6 months. That is the key, guys. That is the goal. That is building wealth in the information age, the way I see it. It's not one-pronged approach anymore. It's a two-pronged approach. And then a three-pronged approach is not just looking for, I'm going to have my money work for me in a compounding way. I'm also going to use my income to start diversifying in cash flowing assets or buying stocks that you can sell calls against to create more income for yourself and be able to not get eaten alive with inflation. That's the third piece of it. Inflation's eating your ability to buy gas, your ability to go out as much as you used to, your ability to, Christmas is, a couple months away. People are starting to buy Christmas presents earlier because of the cost. Well, what if instead of taking the money that you're compounding in the market and spending it on yourself, what if you had that money compounded for long-term investments, and then you had a separate piece of money that you were growing at a steady rate, just buying stock and selling stock, selling the calls on it every month, taking that money and not spending it until it grows a little bit, but then once it grows a little bit, you can make 10, 15% a month on that money, and that allows your income to outpace inflation and keeps yourself in the same lifestyle you're accustomed to. And then the beauty of it is that money continues to compound. The same trade you did, now that 15% has an extra zero on it. And then your lifestyle changes, but the work stays the same. That's the beauty of the three-pronged approach to the stock market with a tradable, compounding strategy and indexes. Buying select stocks that move well and selling calls on them for income. And then having an IRA where you're growing for retirement and investing well in not just stocks, but also cash flowing assets in your community. There's always somebody that's building a brew. I had a guy in here earlier today doing an interview, okay? Had a brewery he built. He was a lawyer. Lawyers are not generally cash rich, okay? He probably tapped a loan to build that place. Now, if he had come to me, he could have tapped my money without having to go to a bank, and I bet they didn't charge, like the interest on his loan is way more than what I would have charged him. See, you can become your own personal community bank, and so many opportunities will abound that other people will never know because you build a network that allows you to see them before they ever reach the light of day and the asking around. That is how to get wealthy in what I would call our economy as millennials and younger. Now, I talk way more about this in the Undercredited Investor. You can go to theundercreditedinvestor.com. There's a link in the description of this podcast somewhere. And I'm going to do an entire video kind of detailing these strategies of how I would trade an index, something like the spiders, and how I would plan and do trades. And I would do the trades using the daily, 3-day, and weekly charts. And I would just compound the money, ba-ba-ba-ba-ba-ba-ba. Before you know it, you're going to have a large sum. So if you want to know more, go there. And the next podcast, I'll talk more in depth about Boomernomics, the idea of when can we really expect and how is this effect of the boomers pulling out money from their retirement accounts going to affect you and me, and how can we be prepared for it?
The views and opinions expressed in this program or any other Rob Review program are not to be considered financial advice, and all these strategies have their own inherent risk. If you act on information given in this show, you are doing so at your own financial risk. Map.Productions does not take part in your positive or negative financial results. That is why I recommend you consult your financial advisor before acting on any of these tips. What worked for Robbie may not work for you exactly as shown in the show.